Hello, hi. Jerry Miller here from Trendsignal, the trader education company. Week beginning the 14th of November, a review of the week ahead. But actually, before getting into what's happening this week, I want to have a quick look at what happened last week. Extraordinary week last week, especially for US equities that put in probably one of their biggest one-day rallies in over 2 years as inflation dipped more than expected. On the week, um, inflation came out at 7.7% again against expectations of 7.9%, and far better than the 8.2% posted last month for September. The core reading as well, which is something the Fed are particularly interested in the States, also was lower than expected, rising just 0.3% month on month, which is better than a 0.5% consensus. And it always felt, looking at the number this time last month, that the inflation would fall because of last month's print seemed a bit of an aberration. Weaker energy costs, which feed through to all products really, um, sort of meant traders were a little bit surprised with last month's reading. So I think this month proved quite a bit of a relief as traders immediately priced in smaller rate rises. And if we have a look at the Fed Watch tool here, that I can explain. So this is what's called the Fed Watch tool provided by the Chicago Mercantile Exchange, and it essentially tells us what the Fed funds rates are going to be on the dates of the next FOMC meetings. You've got the next one to come is on the 14th of December, where rates are 85% probability of rising just 50 basis points now. But what's interesting is we go through to February next year, the next meeting, the first meeting in the new year. There isn't one in January, but you can see that the 4.5 to 4.75 band, which is currently pricing in as a 50.3% probability of rates rising to that level. That was only 19% a week ago. So rates have sort of shifted down 25, 35 basis points. And that's really been reflected in equities. As if we have a look at the equities here, you can see with the S&P, that jumped up immediately on Thursday. Um, and in fact, the move was pretty much in the first sort of 5 minutes. The S&P has actually rallied a whole 100 points following the release and actually ended up 5.5% on the day, making it's one of its biggest one-day gains in 2.5 years. And then Nasdaq also rallying very sharply, rose 7.5%. But on the week, the S&P rose 5.9%, and the Nasdaq a whopping 8.1%. We have had a few false dawns before now, where inflation looked like it was turning a corner. So I'm surprised that the market did react as positively as it did. But react it did. And bond markets also did exactly the same thing. Yield on the 2-year bond fell by a huge 29 basis points or 0.29% to 4.33%. That's just in one day, which is really unheard of. And that's the biggest fall in yields for the 2-year note in more than 10 years. And then you've got the yield on the 10-year, which is what a lot of traders reference. That fell 40 basis points to 3.81. So a massive risk on move, also reflected in the US dollar. We have a quick look at the euro as a sort of proxy for the dollar index, really. You can see that made two big gains Thursday and Friday, really reflecting the change in the interest rate outlook and the pace of interest rates that is expected to slow over the next few meetings from the Federal Reserve. Sterling managed to even claw back some gains, lost ground itself, I should say, gaining 2 or 3 cents, 2 cents last week, hitting 118.50 on Friday. That's the highest level that we've seen in sterling against the dollar since August, and far higher than the 103.5 level that we hit after the disastrous mini budget carried out by Liz Truss and her Chancellor Kwasi Kwarteng. Fortunately, both gilt yields and sterling have reacted positively, but that could all change this Thursday with the autumn statement that is only going to contain some fairly grim news. Anyway, let's get back to our presentation. Oops. Just pause that. Okay, back at my slides. Okay, let's just have a look at what's happening this week on the calendar for key events. It's a big week for sterling markets, but it's not just sterling markets that I'm going to look at. But in particular, we've got the autumn statement, and that's something that a lot of people in the UK are particularly interested in, and that's something that we'll have a look at as well. So let's have a look at the calendar now. So here's the calendar from Forex Factory. Not listed here. It's actually King Charles's 74th birthday today on Monday, the 14th of November. So we can wish him a happy birthday. Joe Biden, it's his birthday next Sunday. That's Sunday the 20th. He will be 80. And if and when he does announce his candidacy for the 2024 presidential elections, and if he is successful, he'll be the oldest president. On that subject, Donald Trump is apparently going to make this, what did he call it? The very big announcement, as he called it last week. Trump could announce his candidacy for US president elections in 2024. I think the midterms have partly derailed some of his plans, I think, which were regarded as very underwhelming for the GOP and the Democrats actually in the end holding on to the Senate even before this runoff vote for Georgia on December the 6th. So Republicans look like they're going to achieve only a modest majority in the lower house as well. So I don't know, maybe Trump's star might be waning. You don't know. So anyway, beginning of the week, we got the G20 meetings are starting in Bali in Indonesia. A lot of stuff that will be going on there. It's quite a talking shop with 20 nations. I say 20 nations. I know Vladimir Putin's not attending. I think he sent his foreign minister Lavrov in his place. But he must be a bit embarrassed, I guess. Anyway, other stuff to look out for on Tuesday. We've got the monetary policy minutes from the Reserve Bank of Australia. Always interesting for the Aussie dollar. UK, we've got unemployment data, or employment data, I should say. Still surprisingly strong, actually, here in the UK, given the fact that almost all economists believe that the UK is now in a recession. We talked about Trump and his announcement, although maybe it won't be with a big fanfare. ZEW Economic Sentiment Indicator. This is a survey of institutional investors, so it's not looking particularly good. A modest recovery from the previous month's reading, but still not brilliant. Minus 54.1. It's likely that Germany is in recession like the UK. US, we've got Empire State Manufacturing. That's one of two reports this week. The other one from the Philadelphia Federal District. An improvement, but yeah, still not brilliant for the time being. The PPI, this is the Producer Price Index. People sometimes get confused about what PPI is. It's really the cost of goods and services going into production, and you could sort of regard it as a bit of a leading indicator of future inflation trends. Wednesday, we've got the important data that I mentioned earlier on, our own inflation report here in the UK. It's released at 7 o'clock Wednesday morning. After the US data came out better than expected, you might think the UK might benefit as well, but the consensus is calling for another jump in inflation from 8.1 to 8.5%, and the strength, I think, is partly down to the strength of the US dollar, which doesn't help with many of the raw materials that the UK has to import, energy costs, etc., all priced in dollars. So until the dollar does start to lose a lot of the ground that it's made this year, I think those pressures won't be relieved. Of course, it doesn't affect the US economy because their currency is the US dollar, but it does affect countries like the European Union and the United Kingdom. Yeah, that's sterling, equities, gilts. They'll all be sensitive to that data release on Wednesday, so watch out for that one. I'm then going to jump to Thursday. There's other stuff coming out, but I want to focus on the autumn statement. The autumn statement is really, it's almost like a budget, isn't it, by the Chancellor of the Exchequer, Jeremy Hunt. He's really having to correct some of the, or a lot of the errors that were made by Liz Truss and her Chancellor Kwasi Kwarteng. The blame game around that still seems to continue. And there isn't any good news really. It's likely that the Chancellor is going to freeze a lot of the bans, income tax bans, inheritance tax bans, and this creates something called fiscal drag, which effectively means it brings in more taxpayers into higher bands, thus generating more revenue for the exchequer. Um, and with inflation running at 10.1, 10.5%, whatever it is, a lot of people will be brought into those higher bands. And they're talking about freezing these bands until 2028. Um, Moves around inheritance tax and also capital gains tax as well. So we'll find out on Thursday. But apparently, the split is sort of 35 billion on cuts in expenditure and roughly 20 billion on tax rises. So either way, um, we're all going to end up paying more. Yeah. What else have we got coming out? Christine Lagarde talking. She's the chairperson of the European Central Bank. She's speaking on Wednesday evening, Wednesday afternoon, I should say, at the the European School in Frankfurt. That's where it is not particularly important, but any central bank governor that speaks generally sometimes can let slip about monetary policy. Anyway, back to Thursday, which Philly Fed already mentioned the Empire State one. This is the second manufacturing reading in the States. Like the Empire State, it's a slight improvement, but still not brilliant. And then we finished the week with a rather gloomy report on retail sales in the UK. I say gloomy, it's actually better than the gloomy one from the previous month. Minus 1.4% was the report last month, a modest uptick this month. But gosh, it's difficult to get too excited, isn't it? It just feels just gloomy. That's it, really. Anyway, thanks very much for listening. All the best. Bye for now.